Welcome to the Future of Finance series hosted by the International Institute for Sustainable Development and the China Council for International Cooperation on Environment and Development. We are so excited to be kicking off this series with you all. This is our first session on sustainable investing trends in 2021. And this is just a quick plug that we will be having 2 more sessions in the same time and place tomorrow and Thursday. Tomorrow on nature-based infrastructure and Thursday on gender lens investing. So I hope you'll stay with us all week because these are very important topics for the future of finance, and we're looking forward to diving into them with you all. And without further ado, I'll jump right into the program with Scott Vaughn, who is going to be giving us our opening comments. And Scott is the Chief International Advisor for CCICED and also used to be the CEO of IISD, so is very much into these issues every single day. So Scott, I will pass it over to you for some opening comments about this series. Thank you.
Great, thank you very much. And first of all, just thanks very much to Callie Taylor and David Juzoko and Joe Zhang and other wonderful IISD colleagues for pulling this series together. And just to say, the China Council has been working on issues of green finance, sustainable finance now for many years, well over a decade. So really looking forward to the discussions today, and also just a fantastic panel. I'll just give a shout out to Stephen Hines. I mean, Stephen was one of the leaders before Paris on the issue of divestment. And then also we're going to be joined by, and also continued China-US dialogue during the previous Trump administration. And then also Dr. Matt Jun will be joining us, and he's been really at the center of issues around green finance, both within China through the G20, and now looking more broadly beyond green bonds at what China calls a system of sustainable finance. So I'll just very briefly mention 3 areas of current work at sort of a higher level of framing that the China Council has been looking at. And the first is carbon neutrality. And since the September 2020 announcement of China pursuing carbon neutrality by 2060, the work has intensified right across the board at the sectoral level, the fiscal policy space, international issues around similar to the European Union Green Deal and now the emerging approaches of the Biden administration across the board. And within the center of that is a discussion of climate finance, in particular in the context of interim targets. So what does it look like over the next 5 years, 10 years, 15 years from the financial sector's side and role in getting to that carbon neutrality target. And there's over 100 countries now similarly have announced neutrality targets mid-century or later. I think one of the issues, there's been an intensive EU-China discussion around green finance, particularly around issues around common taxonomy. I think it was useful to note John Kerry's comments of last week, following his first trip and visiting the European Union, saying that, potential to look at US-EU common taxonomy around green finance. And I think there's an opportunity to look at a sort of a wider 3-way discussion involving China, US, and the European Union on this. The second issue we're looking at actively is conservation finance. And there's just mention a couple of dimensions of this. The first is just what will be the implications of the ongoing work of the task force on nature-related financial disclosure. I mean, I think one of the big questions with this is whether or not it can follow and have a comparable impact to the TCDF on looking at changing financial markets and how they think about risk and disclosure. In addition, one of the other areas that's really been IISD has been a leader in this is just thinking about what is the role of public finance, and particularly subsidies in agriculture and other areas, and whether or not subsidies are offsetting or neutralizing any efforts on conservation and other work. And then the final one I'll mention is at the international level. There's been lots of discussion about the status and the future of the Belt and Road Initiative, and shifting to a greener Belt and Road. The China Council's work is taking two sort of aspects of that. The first one is looking at ways to significantly reduce financing in the fossil fuel sector outside of China, and that work continues. And then the second one, which I've been working on and many others have as well, is that particularly in the context of post-COVID-19 economic recovery, we know that debt overhang is going to be absolutely significant and will be here for decades to come. So the opportunities which are under discussion now is pathways on looking at sovereign debt and aligning that with Paris, with the UN Convention on Biodiversity and the Sustainable Development Goals. And just to say, there's been a lot of work which is now accelerating quite significantly in the World Bank, in the International Monetary Fund, in UNDP, and as well as in many think tanks and others, on looking at what are the opportunities for debt for nature swaps, debt for climate swaps, use of blue bonds, green bonds, and other ways of thinking about this debt crisis as a way to do alignment with sustainability. And so with that, I'll stop to say I'm very much looking forward to the discussions today. Again, thanks very much to Callie and others, and thanks very much.
Thanks so much, Scott, for that. I think that's really great framing, not only for today, but for the next few days of these conversations. And I also wanted to give a quick shout out to the chat, where I'm seeing people from all across the globe who are here participating. It's really great to see such a diverse group, because as we know, of course, that finance is a global issue. So now I'm very pleased to pass it over to our moderator, Peter Cripps, who is the editor of Environmental Finance. And Peter is going to guide us through the discussion today with our fantastic panelists. And as I mentioned again, please make sure to note any questions you have in the Q&A box. And of course, you can let us know where you're from in the chat box. So Peter, I pass it over to you.
Brilliant, brilliant. Well, thanks very much for that, Callie. Hopefully you can all hear me, and thank you, Scott, for those framing comments. That's very useful indeed. So again, my name's Peter Cripps. I'm the editor of Environmental Finance. I'm very grateful for the opportunity to help moderate a panel discussion today. So we have some fantastic speakers for you. I'll briefly run through them. We have Stephen Heinz, the President and CEO of the Rockefeller Brothers Fund, Dr. Ma Jun, Chairman of the Green Finance Committee and China Society for Finance and Banking. From Pictet Asset Management, or Pictet Group, I should say, with Mary Law Schaffelberger, and she can give us the perspective from an asset management point of view, and also from the IISD, we have David Uzoki. So the way we'll do this today is I'm going to ask each of our speakers to give us a brief introduction, and then we will have a panel discussion. Obviously, I have some questions, but also people from the audience are welcome to chip in with their own questions, and I will try to look through on the chat box and identify some questions from the audience as well. So I'm really grateful to have the opportunity to speak, particularly as China is pretty much the most important country in the world when it comes to climate change. So it's brilliant to have Dr. Ma Jun with us today, and we can talk a lot about China's role in climate change and other kind of environmental problems and solutions, and international cooperation about that as well. I've been editing Environmental Finance for about 8 or 9 years, and I used to joke that environmental finance was a contradiction in terms when I first took over the role, but we're really seeing it become more mainstream and more overtly material to the investment community. And it's great to see that there's such interest in climate change and broader environmental issues at all levels throughout the financial system now. The reason that I was asked, I think, to moderate this panel is that I put together a piece for our magazine looking at some of the themes to watch for 2021. And David said it would be useful for me just to run through some of those, just to frame the debate. And so I'll very quickly rush through them so that we can leave as much time as possible for the speakers. But some of the main things, which are kind of building on Scott's comments really, is that, well, COP26 is due to happen this year, and this is a huge COP. For climate change. Obviously, it was supposed to happen last year. COVID delayed it, but we're seeing more and more countries, including China, making net zero commitments. And these talks in Glasgow are set to be hugely important. And we're just going to see a ratcheting up, I think, of net zero commitments from countries over the course of the year. But it's also something that the financial institutions more broadly are getting involved with all kinds of companies and investors also making net zero commitments. The question, I suppose, is how credible are they, and how should they be judged? Because obviously it's very easy to set a 2050 goal for being net zero, but how credible are they? What's the strategy? What scenarios are being used? And I think that's really something that we'll have to pay a lot more attention to over the next few years. You have this danger that commitments are easy to make, but how do you actually follow them up? But we are seeing more countries making commitments, and one of the most important developments in the world at the moment has been really the change of administration in the US and the complete change of tone that we're seeing towards climate change from one extreme to the other almost. So it'll be interesting to see the extent to which the US can really step up to the plate and lead over the next year. One of the other big changes that we've seen in this space in recent years has been the fact that central banks and regulators have come to join the party in recent years, and it's been an absolute game changer in terms of the tone that it sets and the fact that it wakes people up in financial institutions when the regulator starts saying, yes, this is a systemic risk, this is material, and we're going to start stress testing, we're going to start telling companies and investors that they need to be taking this seriously. Probably this trend was led by Mark Carney at the Bank of England, but we now have the Network for Greening the Financial System, and it's great to see that the Federal Reserve from the US has now joined that. But we're expecting to see much more action from regulators over the next few years, and they should really be driving change throughout the financial system. Obviously, climate change is kind of the big issue that we all talk about. But natural capital, including biodiversity, is another area which is really coming to prominence in recent years. And we heard Scott mention earlier on about the Task Force for Nature-related Financial Disclosures. Can it be as influential as the Task Force on Climate-related Financial Disclosures has been, although it's still really only just getting going. But there's a lot of work going on in terms of natural capital and how to try to build this in to investment decision making. At the moment, the data isn't there, and it's not even quite often overtly obvious why investors should be caring about natural capital. The case is much more clear for climate change, because we have the North Star, the guiding agreement of the Paris Climate Agreement, and potential carbon pricing being brought in around the world, including in China, although obviously the environmental lobby would say that the price being put on carbon is not high enough. But how on earth do we go about building natural capital, biodiversity, those kind of considerations into financial accounting? We're a hell of a long way from it at the moment, although the pandemic has given us a wake-up call to biodiversity loss. Some of the other big themes that we're looking at is the fact that the green bond market has expanded out in recent years. It's now much broader than that. It's been a hell of a year really for social bonds, as countries, as international financial development, financial institutions, companies, all kinds of players started issuing social bonds to help to fund their response to the pandemic. But last year also saw the launch of the sustainability-linked bond principles, and that's another new area of the market which has potential to grow. And that's particularly exciting as well, because it can see the coupon of a bond linked to some kind of sustainability KPI. So this is another rapidly growing area of the market. And we heard as well Scott mention about other types of instruments which are increasingly being coming to bear, such as blue bonds or payment for nature services, that kind of thing. So there's a huge area of innovation in the bond market, which has got potential to really be transformative in coming years. One of the things that we write most about, it seems at the moment, at environmental finance is the EU's Sustainable Finance Action Plan. This is already starting to have implications up for the market, with the SFDR coming into force just last week, which is designed to help to combat greenwashing in the markets. And really, if you look at the Sustainable Finance Action Plan, that again is only just getting started, with the taxonomy just for the climate change measures just being thrashed out at the moment, and then future taxonomies set to come for areas such as biodiversity or circular economy. So there's a long way for that to go. And whether or not you agree with the thresholds being set in the taxonomy at the moment, what is interesting, I think, is that this is perhaps the biggest kind of concerted effort by policymakers to try to integrate sustainability factors into the financial system. And so that's a real signal of intent going forwards. Another area that we write a lot about is impact investing. It's becoming more and more prominent, but remains a niche. In recent years, we've seen ESG truly go mainstream, and I would argue that that's probably because it's been easy for people to begin to argue that ESG risks and considering those are material for investors, and therefore it's within a fiduciary duty of a prudent person to be considering ESG. Impact is something a bit different, more focused on outcomes than mitigating risks. And it will be interesting to see the extent to which impact investing really comes to the fore in years to come. Obviously, the Sustainable Development Goals, we've got a long way to go for 2030 to try and get those rather utopian goals put into place. And the financial community really has to play a key role in that. And another area of interest at the moment is carbon markets. We're seeing more and more carbon markets come in, and more commitments to ramp up the pricing of them. Running alongside that is the voluntary carbon market. And we saw a task force initiated by Mark Carney to look into scaling up the voluntary carbon markets in recent months. They did a report in January, I think it was. But actually the voluntary carbon market itself is contentious, because there's two schools of thought on it. One saying that it has a role to play, even if only temporary, in helping to reach the Paris agreements. Others saying that really it's a way of companies or other actors buying their way out of making sustainable and meaningful transformative action. And it therefore is a distraction and is more of a hindrance than a help. So that's some of the issues that I mentioned in the look ahead piece to 2021, which hopefully can help to frame some of the discussions going forwards. But I'll now hand over to our speakers. I think first of all, we're going to hear from David. If you would like to lay out your stall ahead of our discussion, please, David.
Yeah, thank you very much, Peter and Scott, for this introduction. So actually, I'm going to speak about two different things. So first, I'm going to kind of set the scene about where sustainable investing is today. And then I'm going to focus on some of the trends to watch in 2021. So just to get started, I completely echo what Peter, what you just said. Sustainable investing has come very far in the last 5 to 10 years. And I'm sure we can all agree that sustainability has become one of the most important megatrends in the financial industry. I think we could say that even it has become mainstream when we look at like the sheer number of ESG funds that are popping up last year, for example. So on this slide, you can actually see you can see like a definition of what sustainable investing. First, I believe that sustainable investing represents an evolution from traditional investing. And how I define it, just to make sure that we are all on the same page for the sake of this session, is sustainable investing is an investment approach that incorporates environmental, social, governance considerations in investment decisions to actually better manage risk and also potentially enhance long-term returns. So in light of this, I actually share some numbers that can give an indication about the size of the market and its recent growth, as you can see on the slide. So first of all, $4 trillion is currently flowing into sustainable investing every single year. So I think this is a very impressive number. And as of the 2018, sustainable investing has reached about like $31 trillion in developed countries alone. And also I came across some numbers for 2020, and that they actually estimate that we have about like $40 trillion following some kind of sustainability mandates in 2020. On the next slide, you can actually see that this growth trajectory is unlikely to slow down anytime soon. So according to Deutsche Bank, actually in the next 15 years, we will have about 160 to 170 trillion US following investment strategies. So basically, I mean, as you can see it on the chart, like in the next 15 years, as I said, we will actually reach 170 trillion US following sustainable investment strategies. So what this actually means that in about 15 years, we will reach close to 100% ESG integration in asset management. So that's certainly an impressive growth. So the question is really, what is driving this growth? And well, for one, I mean, the ESG funds have recently received a lot of press on how they outperformed traditional funds in the last couple of years, but most notably during the pandemic in 2020. I also believe that this growth is driven by several factors. So first, changes in policy and regulation, and also changes in investor preference. And there is also a generational shift that we are seeing, where we have an ongoing wealth transfer to millennials who are twice as likely to invest according to their values than the previous generation. And also I would like to emphasize as a driver that there's also better awareness of the financial materiality of ESG and climate-related risks. So the next slide, just quickly, I just want to show you that I actually have published a report on this, on to understand better how to get from 30 trillion US dollars to 170 trillion US dollars, and what will be the different drivers that are going to drive this growth. So if you are interested in more detail, I encourage you to take a look. On the next slide, I kind of want to go back to the topic of the session that we are discussing today. It's the trends to watch in 2021. So here you can see a list of some of the trends I see in sustainable investing. They are, of course, much more than that. So there's much more than 4. And I'm sure that the other speakers will cover those. I mean, Peter actually talked about many of them. So the reason I selected these 4 is that I believe that these areas are very important, and therefore they need to get more attention in 2021. So let's look at the first one. So the improving the quality of sustainability. So I certainly welcome the rapid growth in sustainable investing that I mentioned earlier. But I think it's also important that the sustainability ambition of some of these ESG funds and ESG instruments improve. So basically, what I mean by that is that I want to see mainstream sustainable investing moving from light to dark green. And I feel that that we have focused too much on quantity and less on quality, which is, I think, fine at the beginning. So as sustainable investing was taking off, but I just but I believe that it needs to just evolve further in the coming years. And the next trend I want to emphasize is impact investing. And actually, Peter touched upon this already, so maybe I should be reading the environmental finance less because he's influencing me too much. But I think impact investing is very important. I mean, impact investing is like it's about like $750 billion US now. So it's a fraction of the overall sustainable investing space. I mean, if you recall, I just mentioned earlier that sustainable investing assets under management is about like $40 trillion US. So why impact investing is important? Well, because ESG investing basically focuses on investing in companies that have a low environmental, social, and governance risks. So here the emphasis is on the risk. So this does not necessarily mean positive impact. So I would like to see more focus on opportunities in addressing the sustainability objectives, and impact investing, I believe, is an excellent way to do that. And the next trend I wanted to highlight is gender lens investing. So there is an increasing level of awareness of the societal, economic, and even financial benefits of gender diversity. So for this reason, I would like to see, and actually I expect to see, gender lens investing getting a lot more attention in 2021. Our work in this area has focused on advocating the integration of gender considerations in all sustainable finance instruments and funds, irrespective of their thematic focus. So we will talk about this actually more on Thursday, in the session on Thursday. So if you are interested, I would encourage you to join that session. And my last point that I want to actually discuss here in my introduction is natural capital. And again, it's something that actually Peter touched upon. So I expect to see an increased level of ambition when it comes to determining the spectrum of environmental objectives that financial instruments target. So what I mean is that the E in ESG shouldn't just be about carbon and climate, while both of them are very important, of course, but I just want to go beyond that. And I believe biodiversity, natural capital financing should get, and I think it will get actually more spotlight in 2021. I also believe that nature-based solutions need to become an asset class. And what I mean by this is that they need to become investable for mainstream investors as well. So actually, that's why we decided to have a dedicated session on this topic that will take place tomorrow. So if this is something that you're interested in, how nature-based capital can become an asset class, please join us tomorrow. So that's all for my introduction, and I'm very much looking forward to the discussion. Thank you.
Brilliant. Thanks very much for that, David. That gives us a good platform to build from for the rest of the discussions. Let me turn now to Stephen Heinz, who's going to talk to us from Rockefeller about the market value of the fund and how has the fund's mission-aligned investment mandate evolved over time, and how might it change in coming years. So hopefully you can hear us, Stephen, and I can hand over to you.
Good evening, good afternoon, and good morning to everyone. Thanks very much for having me with you, and thank you, Scott and Peter, for organizing this, and IISD and CCICED for pulling this gathering together. It's a pleasure to be on this panel with such a distinguished group of leaders in the field, and to tell you a little bit about the work we're doing at the RBF on mission-aligned investing. I also want to note that I'm a very proud member of CCICED, an organization that I think has great significance, and it's been a real wonderful learning experience for me, and a place where I always come away feeling a sense of optimism about the future. So for those of you who aren't perhaps familiar with us, let me just quickly tell you a bit about the Rockefeller Brothers Fund, or RBF, which I have been privileged to lead since 2001. The RBF is a private American foundation that was founded in 1940 by the grandchildren of John D. Rockefeller, who of course was the founder of the Standard Oil Company. One of the RBF's core areas of focus in our philanthropy is advancing solutions to the climate crisis, both in the US and around the world. And we've been involved in this work since the 1980s. And I'm very proud to say that we also have a representative office in Beijing, which supports work to advance healthy and low carbon development in China. For most of our 80-year existence, our investments were rigidly divided or separated from our grant making. The purpose of our investments was to maximize financial returns to our endowment, and the purpose of our grant making was to advance our philanthropic mission. But around a decade ago, we began to challenge the logic of this strict separation. I mean, after all, we were spending tens of millions of dollars a year to fight climate change, and yet our grant making was funded in part through investments in the very fossil fuel companies whose products were most responsible for the problem. And as evidence about the severity of the crisis continued to mount, and as American policymakers persisted in their stubborn inaction, the ethical tensions inherent in our own policies and practices at the foundation began to feel more and more acute, even hypocritical. So we took an important step, a first really important step in our mission-aligned investing journey in 2010, when we committed to allocating 10% of our portfolio to impact investments. And our portfolio is not huge, but it's significant. It's about 1.4 billion US dollars. But the most important milestone, I think, in our work came in September of 2014, and Scott mentioned this briefly earlier, when the RBF announced its decision to divest entirely from fossil fuels. And as you can imagine, given that the original source of the wealth that created our foundation was the Standard Oil Company, the decision to divest from fossil fuels was a really important and big decision for our board, half of whom are members of the Rockefeller family. At the time, in the fall of 2014, about 800 individual and institutional investors controlling roughly $50 billion in assets had committed to divesting, hardly enough to make a dent in the multi-trillion-dollar fossil fuel industry. So, of course, many people at the time viewed RBF's decision to divest as purely symbolic. But since 2014, the divest-invest movement, as we call it, has exploded in the United States and around the world. Just a few illustrative data points. As of today, over 1,300 institutions and nearly 60,000 individual investors, controlling a total of 14.1 trillion US dollars in assets, have committed to joining the divest-invest movement. Pension funds and sovereign wealth funds have committed to divestment, including in Norway, Ireland, New York State, California, and many other places. Private investors are recognizing the financial risks of climate change. I was at a meeting just last week with Larry Fink from BlackRock. And of course, Larry has made headlines recently with his letter calling on companies held by his $9 trillion fund to achieve net zero emissions by 2050. And as we've heard already this morning, ESG investment funds have more than doubled in 2020 over 2019. And Deutsche Bank projects that they will surpass 100 trillion by 2030. David encourages us to think that it's going to reach 170 trillion a little later on. And part of the reason I think that the sustainable investing movement has been so successful is that the economics harmonize beautifully with the ethics. When we announced our decision to divest, we believed that more profitable and less risky investment portfolios could be created without exposure to coal, gas, and oil. Divestment, we thought, was not only the right thing to do, it was the economically prudent thing to do. But of course, we didn't know for sure. But I'm happy to say that so far we have been proven to be correct. In May of last year, we released a case study looking back at our financial performance in the 5 years since we announced our commitment to divestment. And the top line result was that our investment performance exceeded our expectations. Specifically, over the 5-year period that ended December 31, 2019, our annual net return averaged 7.76%, which exceeded our benchmark by over 100 basis points. And this case study is available on our website if you're interested. Now, of course, I want to be clear that our divestment story, the specific case at the Rockefeller Brothers Fund, does not prove that a divestment strategy is always and everywhere going to be more profitable. As any investment professional will tell us, past performance is not indicative of future performance. But I think our story does help shift the burden of proof. You know, when I remember at the press conference at the United Nations in 2014, when we announced our divestment decision, we were asked, isn't it too risky to divest? And now as the evidence mounts, the question really is, isn't it too risky not to divest? So where are we going to go next? Well, the success we've had with divestment has emboldened us to move more quickly with our other mission-aligned investing goals. We've raised our impact investment target to 20% of our assets, and we have about 14% already committed. And I want to be very clear about this point. Our impact investments are non-concessionary. These are market rate investments that we expect when we make them to produce the same returns that any other investment we might make need to produce. And investments that advance the low carbon future are nearly 11% of our total portfolio. And we expect this to grow in future years. But we also have impact investments that support microfinance in underserved communities, workforce housing, healthcare and scientific innovation, et cetera. And in addition to the impact allocation, another 25% of our portfolio is now invested in ESG vehicles more broadly. The next frontier for us is supporting diversity in the investment space. And I was very happy to hear David talk about gender lens investing. We're also not only looking at gender lens investing, but of course, in the context of the United States, racial equity as well. And it's just a frustrating fact that investors underestimate the value of funds managed by women and people of color, which actually produce returns that are statistically indistinguishable from those led by white men. So a year ago, we announced a new commitment to invest 25% of our portfolio with firms that are majority owned by women or people of color who are underrepresented in the financial sector. As with our other mission-aligned investing efforts, we are going to be regularly reporting on our progress against this commitment and the lessons that we learned along the way. And all of this information is available on our website. The sustainable investing movement has come a long way over the past decade, as Peter said in the beginning, when it used to be considered an oxymoron. And I'm very excited about where we are. But I think, as Peter and David have also said, while we can celebrate the movement's progress, we must remain clear-eyed about the difficult path ahead. Carbon emissions, global temperatures, and sea levels all continue to rise. To keep our planet habitable, we need concrete and measurable plans rather than more empty goals and targets. We need real action rather than rhetorical commitments. Above all, we need a paradigm shift in the global economy itself. Thank you very much.
Well, thank you very much for that, Stephen. That was brilliant. And as you can imagine, I've got plenty of questions for you, but we're going to give all the other speakers a chance to set their stall out first as well. So next on our list is Dr. Ma Jun. He's going to talk to us about what is driving sustainable investing in China, and are the trends we've discussed at the global level similar in China, or are there particular issues that are more salient in Asian markets? So Dr. Ma Jun, hopefully you can hear us. I know you had some technical problems earlier on. Are you there?
Yes, I'm here. Can you hear me, Peter?
Yes, brilliant. Go for it. I'll mute myself. Go for it.
Thank you very much. I will focus on the topic of carbon neutrality and how the financial system should be made more aligned with the goal of Paris Agreement. As you know, China announced its carbon neutrality target back in September last year. And now every ministry, every large financial institution, and all the industrial associations are talking about how to implement that carbon neutrality goal. In the financial sector, we are discussing at least the following 4 or 5 things on improving the green financial system. One is on taxonomy. As you probably know, China has already developed 3 sets of taxonomies for green finance, of taxonomy of green loans, green bonds, green projects. But looking at or comparing with the goal of carbon neutrality, we think the current taxonomies are not perfect. We need to improve them. And the main point is that we need to remove those green projects which were included in the previous taxonomies, but still generating too much carbon. These are the projects, for example, the clean coal technology need to be removed. It has been removed in some of the taxonomies, such as the green bond, new version, and it will need to be removed from other taxonomies for green loans and green projects. That's point one. The second point is on disclosure. We have developed some disclosure standards in the past few years. For example, the highly polluting companies were asked to report their pollutants on a mandatory basis, and the listed companies were given a mandate to be either reporting or explain. But still, I think most of the reporting and disclosure were focusing on the pollution-related issues, but not enough on carbon-related or climate-related issues. So going forward, we need to enhance carbon-related disclosure by, for example, requiring financial institutions to begin to report the carbon footprint. Not just the carbon footprint of the building of the bank, but also you have to report the carbon footprint of the projects that your lending operations are supporting. And only by knowing the carbon footprint of your loan portfolio, a bank will really can develop a roadmap towards carbon neutrality for their lending operation. And similarly for other investors, including equity investors, they need to know the carbon footprint of the portfolio company that they're investing in. The other thing on the disclosure side is we need to ask the financial institutions to begin to report to the brown assets or floating/high carbon assets. Previously, most of the banks, they love to report the green loans and how much great things they have done, how much emission reduction they have achieved. But we need to tell them that you need to know how much brown stuff you are doing and how much you are reducing your brown exposure in the coming few years. That's a second dimension of the future improvement. The third thing is about incentives. We had some incentives in our green financial system in the past few years. For example, the green re-lending facility offered by the central bank, which essentially provided low-cost funding through the commercial banks to support green projects. And some local governments were offering subsidies and guarantees for green projects. Now, these things are not enough, once again, against the carbon neutrality goal. We have a huge amount of low carbon projects coming in. According to one study by Mr. Xie Zhenghua's team, they are saying that China will need to invest 138 trillion RMB in low carbon projects in the coming 30 years. And the current operation of the re-lending facility and subsidies and guarantees are just way, way too small to be meaningful. And what we need to do is to expand the green re-lending facility significantly. My personal view is that the scale of the re-lending facility need to cover at least I think it need to increase by many folds compared with the current level. And also we have to consider the adjustment to risk weights in the banking system for green versus brown assets. Namely, we need to reduce the risk weights for green assets and increase the risk weights for brown assets, and thereby creating a cross-border incentive for green lending and creating a significant disincentive for lending to brown assets. Now, just a few words on international collaboration. That's a major part of our green financial system, and we realize that there's so much spillover or externality of any country's green activity, including green financing activities. So coordination of some of the rules and disclosure standards and the policies will be very much the focus of international collaboration, especially under a few major platforms that China have been involved in. For example, the G20 started in 2016. We kicked off the G20 Green Finance Study Group, and it lasted for 3 years between 2016 and 2018. I had the honor to co-chair that study group. It didn't continue in the past 2 years. And fortunately, this year, Italy being the presidency of G20, they decided to relaunch the G20 Sustainable Finance Study Group and invited China and the US to co-chair the study group. And there has been a decision already that this study group will be co-chaired by China and the US. I'm hopeful that the G20 will discuss some of the very important issues that require global coordination, such as disclosure, taxonomy, and the role of international financial institutions. And a couple of other platforms internationally are also doing a lot, and we're participating actively. For example, IPSF, as I think one of you, maybe Scott, mentioned that there's a harmonization efforts going on under the IPFS, which is the working group on taxonomy, and it will develop a common ground taxonomy based on the Chinese taxonomy and European taxonomy. And hopefully by second half of this year, this document will be out. And those markets who wanted to use it, I think it will be able to use it on a voluntary basis. One more thing to mention, the NGFS, which was founded by 8 country central banks, including PBOC, now has expanded to more than 83 members. This is a rapid growth of membership, way beyond our expectation back 3 years ago. And the NGFS is working on many issues at the macro level on financial stability implication of climate change and biodiversity. And at the micro level, we produced a few documents on guiding financial institutions to conduct environmental and climate risk analysis. Someone is asking, what is NGFS? Let me just spell it out. It's the Central Banks and Supervisors Network for Greening the Financial System. It was called NGFS in short. You can go to the NGFS website and look for these documents, especially the environmental risk analysis case studies. I think it's very important for banks, asset managers, and insurance companies, because that document provided more than 30 methodologies developed by financial institutions and third-party research institutions on how to quantify the environmental climate risks arising from your exposure, for example, to brown assets. Let me probably stop here for the moment. I'll be happy to join the discussion later on. Thank you.
That was brilliant, Dr. Ma. Thank you, as ever. That was great. So let's turn to our final speaker, Mary Law at Pictet. Which ESG themes are getting the most interest from Pictet's clients, and are you seeing any new themes that are gaining traction this year? So Mary, can you hear us?
I can. Can you hear me?
Yes, I will mute myself and let you go.
Wonderful. Thank you, Peter. And thank you so much to the IISD and CCICED for having me on. And it's difficult to come after such a distinguished number of speakers that actually covered a lot of the key trends that we're seeing also from our clients. Maybe a quick word on Pictet for those of you who don't necessarily know us. One of the reasons you may not have heard of us is that we are actually independent, privately held. And this unique governance structure also really gives us an independent approach. We're a private bank and asset manager here in Geneva, managing roughly 600 billion in assets, and we've been around for 216 years. So we always say it's really part of our DNA to have a long-term view, and therefore sustainability has actually been baked in also to our governance structure. If you think of the fact that our partners, 7 of them, have an average tenure of 21 years. A decision taken today actually has consequences for them 21 years down the line, if not more, which is very different from a listed company, which tends to have an average tenure, which is closer to kind of 5 years or so. And this is also why we've actually been active in sustainability and responsible investment for about 30 years. First through socially responsible investment strategies, and then through thematic funds, which is what some of you may know us for, investing across environmental and social themes around water, clean energy, so broad environmental and social themes. Today, that represents roughly 36 billion in assets under management in those themes. And to come back to the points that have been made by many speakers before, this is one of the areas where we also saw the most inflows over the last years. In 2020, 6.3 billion were raised in actually environmental and social themes, and mostly on the environmental theme side. So it just gives you, it kind of brings in from an actor in the market that we are seeing that trend, and we're seeing clients move to this area. We've also been very active on our own assets, and I think this is something that is really important for us, is to have that holistic approach. And I think we heard Stephen mention that also from the RBF fund, that this trying to tie it all together. So last year, we also announced that we would be removing all fossil fuel producers and extractors from our own balance sheet. And we've also created, for example, a pocket of impact investing within our own pension fund. So just a little bit of what we're trying to do to bring those two areas together, not just what we're doing for client assets, but also what we're doing on our private assets. But without further ado, I think it's important to go into what we're seeing from our clients. And there's really 3 big trends that let's kind of tie into what we've heard today. And I think David will be happy to hear that one of the big trends is actually moving from process to outcomes, right? So we are moving from a world where actually people would just hear, okay, ESG integration for risk purposes because we don't want our financials to suffer, to clients coming and asking, well, okay, concretely, what are the outcomes of my capital in the real economy? Right. So what is happening to those capital flows? How are they impacting society and the environment? And we're really moving from kind of a narrow view of environmental, social, and governance integration within financial analysis to a more holistic view of systems thinking of how these capital flows are impacting the real world. And obviously there's challenges linked to this, and we're going to come back to that on metrics and data. But I think that mindset shift is so key in terms of making the system more resilient and more sustainable. And linked to that process to outcomes, what we're also seeing is this transition from pure green to transition, right? So we know that the scale of the challenge we have in front of us as humans is to transition our world to a system which is low carbon, but not just, right? It needs to be low carbon, it needs to be nature-based, it needs to also allow people to flourish and have well-being, and we need to do this fast. So the scale of the change is massive over the coming decades, and that will require not just investing in things that are already green or just the ones that are enabling this transition, but in the companies that are brown today, potentially, but have a trajectory and a credible trajectory and a plan to get to a better place. And that is also where we're going to get a lot more impact. But you need to be able to demonstrate that. You can't just say you're doing it, you have to be able to demonstrate it. So that's one big trend, I think, really this process to outcomes, and linked to that, like the notion of transitioning assets. What's very interesting as well is seeing the move from listed equity, so clients that are happy to get counseling on themes or broad themes that are in the listed equity space, which makes up about 50% of the market, to actually broadening to other categories. And we heard a lot on this call about fixed income, about sovereign debt. Scott was mentioning the work going on around that. It's also asset classes that we're looking at. And roughly more than 30% of the responsible investment landscape today is actually in other asset class, is in fixed income, and the rest is actually in private assets, so infrastructure, private equity. And this is key because those are the areas we need to develop to be able to go further into nature-based solutions, into infrastructure solutions, and developing all of the areas that we need to transition to a better state. So really this move from equity to other asset classes, specifically fixed income, and we're seeing a lot of interest in private assets. And finally, tying all of this together is the increased transparency that we are getting in terms of, it's not just the regulator asking us for this, right? I think regulators are coming in and stepping in, and it's important, but the clients are actually demanding less narrative and more eyes in codes, right? They're demanding that we start to demonstrate what we're talking about in our strategies. So it's not just like a nice fun name, but it actually, we can show through evidence-based or science-based metrics that we're actually seeing that something happening that is improving from an environmental and social perspective. And I think what the European Action Plan is going to really help with, as well as put a bit of structure in all of that. The fact that, you know, the regulator has now stepped in, we heard about SFDR, and said, yeah, okay, there's been an explosion in ESG investing broadly. We can say taken broadly, it's about, we're getting to 50% of the market. Yeah, but what is the quality of that? And I think David mentioned that earlier. If it's ESG integration, right, what the European Union calls Article, or SFDR calls Article 6. I mean, this is simply taking into account environmental, social, and governance criteria into your investment process. Whether or not you then materially make a change in your portfolio, it's not guaranteed. Whether or not you're excluding or underweighting worse rated names, or overweighting worse rating names, or overweighting best rated names, it's actually not a guarantee under that ESG integration piece. So the regulator is saying, actually, what we want to see, right, if you're saying you are a sustainable investment or responsible investment, we want you to have a material impact on your portfolio of the taking into account of these environmental, social, and governance criteria. So we need to be able to measure it, and we want you to start reducing the significant harm that you are doing in your portfolio. And if you move into what we were saying, the dark green, this Article 9 piece, which is you have sustainable investing as an objective, right? You need to not only show that you actually have a material impact in your portfolio, but you need to be able to demonstrate that objective is coming out through, at some point, percentage alignment with the green taxonomy. But also the regulators coming in and saying, guys, you've been talking about the positive impacts of your portfolio, but what about the negative ones? And we have these 18 mandatory indicators on principal adverse impacts, right? Which are taking into account things like GHG emissions, hazardous waste ratios, asking people to show not just the positive, but also the negative, because we know that if we want to transition our system to a better place, we need to have the full picture. Clients need to have the full picture. And what's amazing is they're actually asking for that full picture now. So it's really, we're at a time where it's not just the regulator coming in, it's clients, it's civil society, the level of awareness is going up. And also we're seeing policy shift and the change in administration in the United States, which we've mentioned before, is also going to push this forward very, very strongly. So that was a little bit the overview on my side from our clients, but very much joining a lot of what the other speakers were saying so far.
Fantastic. Well, all of those opening gambits have been fantastic. So we've got about 15 minutes for a panel discussion. Perhaps I could address this question initially to you, Marie-Laure, seeing as we've got you on the line, so to speak. You've talked a bit about which areas you're seeing as being prominent at the moment. But where would you like to see more attention paid to? You know, where would you like to see the areas that should be getting more attention? Perhaps I could ask that question to you in the first instance, and then some of your fellow panelists could join in with their views.
I actually think that there's still need across the board, right? And I know it's people always want to hear, and especially from us, they want to hear what's the next theme you guys are thinking of launching, or because we have a number of environmental and social themes, and people mention, what about biodiversity or gender, for example? But actually, I think all of these themes, broadly speaking, in environmental and social, need to garner more capital. They need to get more capital. They are still a tiny portion of the market if we look at the whole financial market. And this is really key. I think it's fantastic we have ESG integration. I think it's great that people are taking this risk view into account, but fundamentally we need to start to shift much more capital towards all of the areas that need to transition over the coming decades. And that includes the climate piece, which we've talked about, and I'm sure we'll talk about more, net zero. How do you come out with credible products, not just in equity, but across fixed income, looking at how governments are transitioning, for example, looking at how corporates can transition, and putting in place, and I think this is going to be a huge one, the infrastructure that we need, scaling the infrastructure that we need to get there. And so I think those are big areas in environment, but actually and we've seen it in the past in the crisis, there's also huge need in the social space, in healthcare, in well-being. So, I mean, I wish I could tell you there is this one theme that that really needs to get more attention, but frankly speaking, I think we have a lot on our plate, and that's the beauty of it. There's an opportunity for everyone to really bring in value in this space.
Peter, I might jump in if that's all right. I agree with what Marie-Laure has said. I think in the kind of nearer term horizon, the three things we need to be emphasizing are quantity, quality, and honesty. We need more capital going into this. We need it to be going into high quality investment vehicles in all asset classes, and we need to be really honest about what we're doing and report and be transparent. So those are three kind of urgent things, but I think the longer term challenge that we really need to be working on together is redefining capitalism for the 21st century. You know, what we found is that capitalism in its history, ever since the turn of the industrial age, has produced enormous wealth. It's lifted hundreds of millions of people out of poverty. It's improved quality of lives, lengthened life itself, et cetera, et cetera, et cetera. At the same time, we now know that because since the Industrial Revolution, it has been fueled by carbon, it is also throwing the entire planet and planetary civilization into risk. And so we fundamentally have to change our thinking about the economy, about capitalism, and about how we produce and use goods and services if we're truly going to have a habitable and sustainable planet. And so that work is both theoretical, it needs to happen in the academy, but it also needs to happen in the finance community, in the business community, and in the advocacy community.
Brilliant. And Dr. Ma, did you want to join in on that as well?
Yeah, actually, just to follow a few issues that's been raised, especially by Maria. One is on transition finance, and the other one on nature. Transition finance, I think, is hugely important because we pretty much know that the pure green sectors are very small relative to the entire economy. It's probably only 10 or 20% of the GDP, while the other 80% of the economy are either polluting or generating a lot of carbon, and we need to really transform the other 80% towards low carbon and zero carbon. So finance cannot abandon the 80%. The finance has to work on the 80%. That's why the current green financial system or sustainable financial system are not adequate enough because they tend not encourage money to go into these activities that can transform the polluting and high carbon activities into cleaner and low carbon activities. Sometimes it's by definition, these transition finance activities are excluded from the incentives that government is encouraging or from the investors' recognition. So what we need to do is to work on more systematically a sort of ecosystem to encourage transition finance, including defining them clearly. What are the activities that should be classified as transition finance? And we need to have transparency around that, which means that those who are committed to convert a brown company into a green company, you really need to report to the investment community in the coming 5 years or so how much you are reducing in terms of carbon emission or other pollutants. And some incentive need to be put in place to offer low-cost financing, blended financing, and to crowd in private sector money for transition finance. And a lot of pilot projects need to be done. For example, I'm actually working with ADB right now and trying to figure out how to use transition finance to convert a Chinese coal-fired power generator into a clean energy company. And this is something we need to really experiment, because it's not that easy. It's not just finance. It involves technology, changing management, and getting a lot of government incentives. So you need to put together really a package of conditions to enable this to happen. That's why pilot and demonstration projects are very important to popularize that kind of sustainable transition finance activities. The second point on nature, let me just mention under the NGFS, I'm now leading the study group on biodiversity and its relationship with finance. And this work is done jointly with INSPIRE. It's a research network supporting the NGFS. So we're going to have a 1-year research project involving many scholars within the central banking and financial regulatory system from many countries, and from academics, from NGOs, and sector professionals. So we're actually just beginning to form the study group, and we're looking forward to your inputs. Those who are really interested and have insights, knowledge, especially ways to sort of present the concrete evidence on the connection between biodiversity and finance. I think it's more than welcome to join us. Back to you, Peter.
Thank you very much. Well, just pulling you back to your previous point on transition, Dr. Ma, transition/net zero is perhaps the big kind of buzzword which we're going to be hearing about most over the next few years. However, there's a lot of concern around some of the scenarios which are being used to judge a credible transition strategy. With some people complaining that some of the strategies coming out are overly reliant on, CCS coming in to save the day, for example, or some other technology coming in which allows you to carry on as business as usual. How are we supposed to judge transition strategies, and do we need someone like the NGFS to come in with main scenarios which are internationally agreed, which are therefore non-controversial, or is that just not really possible? And how much does this need to be an international initiative to come up with these kind of strategies? How can these transition stories be judged credibly by investors, do you think?
Yeah, I'm not going to comment on the specific technology that will enable the transition. There could be hundreds of technologies, including carbon capture, hydrogen and whatever. But I'm talking about from financial regulators' perspective. The way to judge it is really to measure the reduction of GHG or carbon emission during the process of this sort of a claimed transition period that's supported by transition finance. So if you are raising, let's say, either equity or issuing a transition bond, stating that you will transform a high carbon company to a low carbon company within 7 years, tell me by how much. It is by 50% within 7 years. And then you have to have a milestone every year and report the outcome and getting verified by the third party verifier. So that's a sort of a system, ecosystem we need to make sure that the transition finance really does transition.
And on a related subject, if I understood correctly, Marie-Laure and Stephen have both talked about divesting fossil fuels, but as Dr. Ma said, you know, that there's a strong argument for saying that we can't ignore the other 80% of the economy that isn't green. We had a question come in from the audience about divestment versus engagement. Well, this argument is as old as the hills, but perhaps we could start with you, Stephen. You know, there's an argument to say that you really need to have a seat at the table to make a transition happen.
Yes, as you say, this argument is as old as the hills, and there's no right side to it. I think both strategies are important. From our own experience, and this is, I think, particularly interesting because it was led by members of the Rockefeller family who tried for many, many years to engage with the legacy company of their grandfathers and great-grandfathers, Standard Oil, which is Exxon, to no avail. The engagement really fell on deaf ears, and no change was forthcoming. And they did it directly with company management at the very senior levels, but they also filed shareholder resolutions, et cetera, et cetera. And it was really after about a decade of that kind of work that led them to be open to my suggestion that we simply divest our ownings in fossil fuels. So I think engagement is important. I think that all the pressure we can bring to bear, whether it's through engagement, whether it's through divestment, whether it's through showing the way that positive investment, impact investing can change the market, every one of these strategies needs to be fully deployed.
I completely agree with Stephen. I think there's no silver bullet. There's no one solution. There is a plethora of tools that we can use to get to net zero. And I think that's true also for the energy transition, for example. And it's not going to be one solution. It's not going to be solar, or, you know, it's going to be a plethora of different actions. It's going to be changing our grids, etc. And back to divestment versus engagement. I mean, the reason we took, for example, the decision on our balance sheet is because engagement is great, but it has to be credible. Back to Dr. Madjon's point as well, saying, you know, we're engaging, fantastic, but how do you demonstrate that? More and more, we're going to have to demonstrate that. And so on the balance sheet, we were like, okay, it's probably easier there. Also, it's our own assets, decision we could take immediately not to have that exposure. We took that. Now, what we do on our client assets is we do have a long-term and very structured approach to engagement for fossil fuels. And most of that engagement, frankly speaking, is done collaboratively, because most of the biggest emitters, we would be a drop in the ocean relative to, and I think this comes back exactly to what Stephen was saying. And can you really be credible sending a strong worded letter to the board? You know, no. So you have to work, and through collaborations, we work through the Climate Action 100, for example, which is probably the most effective investor initiative in this space today, and has had some tangible outcomes and that have been published. And so I think, yes, engagement versus divestment both have a role to play in specific areas, but engagement needs to be credible. It cannot be the fig leaf behind which we hide because it's easy and we don't actually have to change anything in the way that we're doing things.
Okay, brilliant. Well, I did promise we'd try and get some questions in from the audience. I'll ask you one more and then we'll wrap up. If we could ask for a quick answer. We've had a few questions come in basically saying that with the recent trends in sustainable finance, are we seeing a tipping point past yet for green or sustainable investment, after which the market will take over as the main driver? Or do we need policymakers more to be driving this whole trend, this transition, if you like? Perhaps if I could ask you all for some very quick thoughts, and then we will need to wrap up, I'm afraid.
Well, I don't think we're at a tipping point yet. And I worry that, in fact, we're closer to the climate tipping point than to the green transition tipping point. And so I think that we need to maintain the pressure. The market is not going to solve this on its own. Advocacy, policy, investor behavior, corporate behavior, all of these things need to change, and the pace needs to quicken before we're going to reach the necessary tipping point.
Yeah, Peter, let me add a few points on why we still need a lot of coordination on policy and the regulation. It's not time to really leave it to market yet. Just give you two examples. One is the disclosure piece. There are lots of initiatives on disclosure reporting standards. When we have too many, it confuses the market, and potentially can also increase the risk of greenwashing. So what we need to do is to gradually consolidate these different initiatives and standards, and move towards a set of globally accepted reporting standard for sustainability, which will cover climate, environment, biodiversity, and so on and so forth. And the second example is taxonomy. Back 6 years ago, when I was co-chairing the G20 Green Finance Study Group, we were complaining about the lack of taxonomy. A lot of organizations didn't know how to define green or define brown. And recently, in a conversation I had with ISO, they were telling me that there are 200 kinds of taxonomies around. And some of these are done by country, by market association. Some of these are produced just by an institution or by a bank or asset manager. So the proliferation of the taxonomy, again, increases transaction costs, especially cross-border transaction costs. Just give you an example of issuing green bond. If you have a Chinese issuer issuing green bonds and wanting to be selling the bonds both to Chinese investors and European standard, you have to meet two sets of standards, and you need to get two verifications. So these are the costs that need to be eliminated in order to enhance the cross-border flow of green capital, and we need to harmonize the standards. That's a piece of work which IPSF is now doing.
Just very quickly, I agree, and I think typically one of the very tangible ways we can see that we need some kind of comparability, measurability and policy around that, or agreement around that, is data, right? Our capacity as an investor to demonstrate that there is a tangible improvement depends also on the quality of the data that we're getting in, and our capacity to have access to data that everyone else has the same access, same access, same data, and that measurability and comparability across products. That will limit greenwashing tremendously and allow us to really demonstrate change over time. So I do agree that it's also an area where it can't be market only. We need to also have other players coming in and adding to the conversation.
Brilliant.
There's also something to add, just very, very briefly, because I'm conscious of time. So, I mean, just to answer your question of whether we are at the tipping point or not, I actually had some meetings with fund managers, and they were telling me that, David, we can actually, I don't know whether ESG has a positive impact on financial performance, but I can tell you that I cannot start a fund without an ESG mandate, because it just helps so much with fundraising. So I think I can see that we are moving from 30 trillion to 160 trillion, just by the markets itself. But for me, the question is where the policy angle comes in, is like how to actually bring in the quality. And that's where we have the discussions about taxonomies, and also that Dr. Ma also mentioned. And so how to have that quality between 30 to 160 trillion, I think that's the question. And regulators definitely going to play a role in that.
Brilliant. Well, I'm conscious of the fact that we're out of time. In fact, we're over time. But yeah, it always seems to me that investors should perhaps spend more time engaging with policymakers who can set the rules of the game, really, as well as engaging with corporates. But yeah, I appreciate that we covered such a broad subject area today. We probably barely scratched the surface, and you can see from the number of questions we've had come into the Q&A panel that we haven't really begun to scratch the surface of answering those either, but we are beyond our time limit. So all that remains for me to do really is to say thank you, that I have learned a lot from speaking to our excellent panelists, and I hope that you have done too. Yeah, apologies that we could go on, but we are out of time. So all that's left for me to do is say thank you to the panelists and to hand over to Callie, who I think will wrap up.
Yes, thank you so much to you, Peter, and to all of our panelists for a fantastic discussion, which really provided the big picture. And I'm happy to say that in the next 2 days, we're going to dive into some of the individual parts of the picture a little bit more in depth. So again, tomorrow we have the nature-based infrastructure discussion, and the day after that, Thursday, we have the gender lens investing discussion. So I do recommend joining us for those. I also am very cognizant of the fact that we have so many questions in the Q&A. So what I'm going to do with the IISD team is we'll attempt to answer some of those from our research and other places, and also maybe circulate them to the panelists to see if they have anything to add, or them or their teams have anything to add. And we'll include part of that in the blog post to follow up, because as was said, this was just scratching the surface. But thank you again so much for joining IISD and the China Council for this very important discussion, and we look forward to seeing you all in the next couple of days.